Best Buy shares are in free fall right now. And so in this video, I'm going to talk about three things. One, the opportunity. Two, how I'm valuing the company. And three, how exactly I'm looking to invest in this opportunity. So that's what we're going to cover in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in that chat. You're watching More Money. Let's get it. What's up, guys? Welcome back to the channel where I just do my best research on the securities markets and show you what I'm seeing. So let's take a look at this opportunity. So you can see that as of the recording of this video, Best Buy shares are on a downward trajectory. They're trading at approximately $79.50 per share right now. And that's after running up 18% subsequent to the end of July, and now of course dropping off a cliff back down to under $80 per share. It got as high as $86 per share, and now it's coming back down. So the question is, what caused all of that positivity in an environment where retailers are getting really banged up? Well, you can see that although based on the guidance provided previously, sales were actually only expected to decline in the mid-single digits, which was much less than the market was expecting. However, note what they said. As high inflation has continued and consumer sentiment has deteriorated, consumer demand within the consumer electronics industry has softened even further, leading to Q2 financial results below expectations that they shared in May. So they continue to bring down their forecast. And so what's troubling the markets right now is that right now there's been a bit of a theory where the market believes that the Fed will stop its hawkish stance on the economy later this year, early in 2023. But the economy is sort of weighing that back and forth right now. They're sort of like moving back on those expectations, and they could see the Fed, or they could expect that the Fed continues to be hawkish well into 2023. So there's a bit of a debate right now as to whether people believe what the Fed is saying. And that really speaks a lot to how the Fed has lost credibility because of their actions previously. And so because of that, it's really hard for retailers to even forecast where the economy is going. However, I believe that Best Buy does a good job in honestly forecasting where they're going to be in the back half of the year. And you can see that they did say that as we contemplate the back half of the year, our current planning assumptions for fiscal 2023 include a comparable sales decline in the range of approximately 11% and a comparable sales decline of 3% to 6%, and a non-GAAP operating income rate of 5.2 to 5.4%. So effectively what's happening here is that if you believe retailers' expectations in this environment, you're a bit of a dummy because they don't even know. So how should we play this? Well, the way that I've done it and the way that I've modeled it out is I've taken the value that they've provided and I've reduced expectations much more because I tend to be a little bit more of a conservative person when it comes to valuing a company. And then on top of that conservative valuation, I usually take a 50% cut to the value and I buy it at approximately 50% of its intrinsic value. So that's generally how I invest. And so you can see here that I'm forecasting a 15% sequential sales decline in fiscal year 2023. And so let's pay attention and see if they reiterate their fiscal year 2025 sales guidance of $55 billion. I actually don't think that that guidance will happen because notice what it does in the model. It would mean that fiscal year 2024, I do believe would only go up by around 5%, but fiscal year 2025 would have to go up by 11%. Now, you could have a bigger recovery in 2024. That's totally possible. And thus 2025 has to go up not that much. It might only have to go up 7% if 2024 only goes up by like 6 or 7%. But I just don't see it. The way I'm forecasting the business out and the way I'm modeling it, as you can see here, is I'm actually bringing 2025 down from $55 billion to $48.5 billion. So that would be a big miss on their 2025 expectations. However, that's how I'm forecasting this out right now because I do believe that this consumer pullback could last longer than just fiscal year 2023 for Best Buy. I do believe that there's reverberating impacts, or at least, you know what? Let's be conservative right now and allow the increased revenue growth to be a unvalued driver. Now, where exactly does that bring my valuation? Well, you can see that using a 15 times terminal multiple, I'm valuing the company at approximately $120 per share. And what that represents is approximately 67% of its value to its intrinsic value, or it reflects 10 times current fiscal year 2023 EPS. But overall, I think this name gets cheaper. And so the way that I'm looking to invest in it is not actually buying the shares. Look, you could buy the shares and get a 10% equity yield while you wait for the share price to recover, and it absolutely could recover. However, I tend to be very focused on downside risk, and so I love cash secured puts. And I found a wonderful opportunity that you can utilize if you want to dive into this opportunity. Now, before I go into the cash secured put opportunities, please note that approximately 80% of the watch time on this channel is from people that are not subscribed. So if you can, please take a second and hit that red subscribe button, and don't forget to hit that notification bell to be notified for future great videos. Okay, now let's get into the cash secured puts. Here's the January 19, 2024 cash secured puts at the $60 per share level. The reason why I'm doing the $60 per share level valuation here is because, remember, I valued the company at approximately $120 per share. So $60 is 50% of that intrinsic value. But note what this does. The 2024 $60 cash secured put is yielding an annualized 9%, and the January 2023s are yielding an annualized 10%. If you're exercised on either one of them, you'll be generating an equity yield of 13 to 15% based on the long-term average earnings per share. This is your classic win-win, and this is why I love cash secured puts. Look, this isn't an opportunity that's going to skyrocket, that's going to go to the moon, but a nice 10%. And on the back end, if you get exercised on this cash secured put, you've end up purchasing this company for a price that's significantly lower than what the current share price is, and thus you generate a higher equity yield going forward. That's a wonderful opportunity in my opinion. And this I would put in sort of like the dividend yielders part of my overall portfolio. I have names that I'm looking for capital gains where the expectation is 15% or more. And then I have names in my portfolio where, 6 to 8% in overall dividend yield is great. And so here's one that's on the upper end of what I think that the dividend yield could be for the portfolio overall. Now, I did share my Best Buy model with you. And so if you want access to that model and all the other models, you can get access to all of those models at the lower tier of the Patreons. Now, if you're interested in more consumer products type stocks, Microsoft does have a large portfolio of consumer products or even consumer software. And I do believe that Microsoft is doing a lot better than what people give it credit for. And so I actually made a video on it, and you can get to that video right here.